US equities rebounded yesterday after an early session dip, with the buyers stepping in near key technical levels this time, however. Yet beneath the surface, conviction remains thin still. The AI trade continues to unwind selectively, with software names under pressure still, and investors in AI enablers or big technology companies are still digesting concerns over debt-funded investment plans. Now, these companies are still safe to invest, suggest bond yields, and we are going to talk about that in this episode. But swimming against the current bearish tide still demands some courage. Meanwhile, in Europe, rotation flows remain in play, particularly in the United Kingdom. The sterling's weakness these days supports the internationally exposed FTSE 100 index, and inflation numbers this morning will come to somehow support the Bank of England doves. Overall, sentiment is stabilizing this morning, but investors are still cautious about what's to come, and they are only cautiously back to buying. So welcome to Swissquote's Daily Market Talk. It's Wednesday, February 18th. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the US equities kicked off the holiday shortened week with a further dip on Tuesday very early in the morning, but this time the dip buyers were just around the corner and helped stage a rebound in major US indices. As such, the S&P 500 saw support around its 100-day moving average as Nasdaq 100 index rebounded from a touch lower than the 24,400 mark. Some software companies released their earnings ahead of schedule to ease investors' concerns that AI will completely destroy their revenues and their business. Some of them insisted that integrating AI in their products will, on the contrary, increase demand for their products and hence their revenue. But in vain, iShares expanded technology software was hit by another 2% sell-off on Tuesday's trading session and the continuation of this AI fear sell-off. I still think that some of these companies right now look like they are good buys. On the other side of this trade, the AI enablers, or the companies that make the AI disruption possible, remain under high pressure as well, and that's due to their massive AI investment increasingly financed by debt. The Round Hills Magnificent 7 index is now down by more than 11% from its October peak last year. We are gently entering the 10 to 20% drawdown zone that will soon become interesting for investors looking to jump back in at discounted levels. So looking at the valuations, Meta's PE ratio, for example, is to around 27, currently below the 2023 peak of 38. Google's PE ratio is down to around 28 from above 30 just a few weeks ago, while Nvidia's price relative to its earnings stands around 45. That's a high level, obviously, but the lowest since the AI boom, and falling due to earnings growth that clearly keeps up with the price rally that we saw there. So at the current levels, valuations do remain high. The massive investment plans financed with that doesn't please investors. As we talked yesterday, the CDS now tied to big technology names, single names are now changing hands out there as a proof that investors are now trying to manage the rising credit risk among these big technology bodies. But I still thought that it was worth noting that the big technology high-grade bonds still see very strong demand from investors, and they actually offer a yield that's just above the US sovereigns. In numbers, Meta and Alphabet's 10-year paper now yield around 4.625%, implying a credit spread in the area of 60 to 100 basis points compared to the US 10-year yield, which now yields around the 4% mark and is considered as being the risk-free trade among investors. Now, we can argue the risk-freeness of the US sovereign papers, but the extra compensation that investors demand for taking the big technologies corporate credit risk today is relatively narrow compared to the US papers, and the letter suggests that investors, despite being frustrated and despite being willing to hedge against rising credit risk today, continue to view these big technology companies as extremely high quality borrowers with quite very low default risk still. In other words, while not technically risk-free, obviously, like the US sovereign debt, because these companies, they cannot print money, well, their bonds are priced by investors as close to risk-free in practical credit terms, and that could eventually help throw a floor under the actual sell-off. But when, I don't know, because I believe that the US big technology sell-off may have some more room to run before appetite fully returns, but each leg down from here will likely start raising the question of, is it over? Is this a dip? Is this a buying opportunity? Now, judging by the 2% slide in SoftBank today in Japan, I will say that no, for today, the time has not come just yet. But next week, Nvidia will be closing the earnings dance in the US, so let's see if the company could bring investors back to appetite when it releases earnings. Fingers crossed. Until then, the so-called rotation trade will likely remain in play. That trade is benefiting the European indices that mass capital moves right now. The FTSE 100, for example, hit a fresh record high yesterday despite the sell-off across energy and mining stocks on falling energy and metals prices, hinting that the sharp sell-off in sterling yesterday following weak jobs report gave support to the index, where companies actually bring around 75 to 80% of their revenue from outside the UK. So when the sterling goes down and dollar goes up, well, the FTSE 100 tends to follow the US dollar higher. So let's talk about that a little bit. British unemployment rate rose to the highest level since the pandemic months. The wages growth in Britain slowed to the lowest levels in over 5 years, and inflation eased, though the report out this morning showed that in some places inflation eased less than expected, triggering a short spike in sterling right after the release. But overall, the combination of the data is excellent news for the Bank of England, those, hence investors, because the sweet combination of rising unemployment and easing inflation is a VIP pass for a rate cut from the Bank of England, and alone is enough to boost appetite across the British assets. Because the Bank of England is now expected to cut the interest rates in March this year, and not in April, and one more time in June, to give support to the British economy rattled by Rachel Reeves' harsh fiscal policies. And the softening Bank of England outlook is supportive of a further retreat in sterling against the euro, where the European Central Bank is seen stable with its rates in the foreseeable future, and also against the US dollar, where the Federal Reserve expectations have softened enough to allow the greenback to gain some field against sterling these days. Technically speaking, cable tested the major 38.2% Fibonacci support in October to February rebound for the third time at yesterday's trading session, and if this level is clear to the downside, the pair will step into the bearish consolidation zone and remain under pressure for deeper losses. Of course, the intensity of the pressure will obviously mostly depend on what's going on the US dollar leg of this trade. The Federal Reserve minutes are due later today and may eventually give some hint on where the Fed members see the interest rates in the US going from here. For now, the expectation is 2 interest rate cuts this year, but opinions at the heart of the FOMC diverge, while the data and the Fed's next leadership's motivations are being increasingly questioned by global investors, making trust in the US data and the US dollar quite shaky these days. Now, the US dollar is attempting to climb for the second straight session in Asia this morning, as the QE, so the New Zealand dollar, is being heavily sold this morning after the Reserve Bank of New Zealand kept the interest rates unchanged there near the lowest level since middle 2022, and said that the policy will remain accommodative as inflation there, though above the bank's target, still is on path to return to 2% mark in the coming year. Will the latter mark the end of the Kiwi dollar's year-to-date rebound near the 60 cents level is yet to be seen, but the US dollar appetite remains weak enough to rule out a meaningful rebound in the US dollar for the moment, so we could still see the Kiwi dollar go above that 60 cents level once the dust settles. Let's see if the Fed minutes give any hint how the markets react and whether the US dollar could rebound a little bit more from the actual levels, or is it going to be back to the bearish trend with the US dollar losing field against most majors. We will see. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.